Today we're going to talk about how to read rate sheets. This is something critically important that every single mortgage broker, loan broker, or whatever you want to call yourself should know. As I always say, any real business loan broker, not a glorified referral agent, should understand how to read rate sheets. So we're going to start off there. I got two rate sheets that I'm going to pull up in front of your face. Let's go ahead and do our thing here. There goes Mr. Loom. This just came in. This is coming from one of our lenders that we work with. They do a lot of investment property, DSCR, those type of loans. And we're going to go over their rate sheets. Lending One is the name of the lender. We're going to move my face out of the way. And we're going to just kind of go over this rate sheet. A few things to keep in mind. Of course, we're looking at mortgage rate sheets. So the terminology used on here is going to be based on mortgages. You're going to hear words about LTV. Of course, there's going to be some basic word that you should know already. FICO score, amortization. You should know what a rate is. When you borrow money, this is the price you pay for having that money. So, I'm going to assume that you already know all of these things. But moving ahead, on this specific rate sheet, and every single rate sheet out there is going to be different. Every lender has their own way how they present their rates. But this specific lender, they usually deal with non-QM loans. Let's kind of go over that real quick. So there's what I call QM loans. QM loans are confirming loans, loans that fit the government criteria of, I think, Fannie and Freddie that can be sold off. Things like FHA, HUD, Fannie Mae, some conventional loans, Freddie Mac loans, HUD loans. These are what you call conforming loans, or qualified mortgages. Non-QM, when you hear that word non-QM, these are loans that don't really fit that criteria. Look at it as loans that are a little more flexible, okay? These are loans for, like fix and flip loans. You will never find an FHA finance and fix and flip, unless it's like an FHA streamline. Anyway, know that there's qualified mortgages, there's non-QM loans, and these specific products, you have to understand the products where you read the rate from. Right here, this specific lender, these are all non-QM loans, and basically, so let's just kind of read these rate sheets. At the top, you see, of course, the lender's name. At the top is the type of product it is. This is a 30-year fixed mortgage with a 30-year arm. What does that mean? It's not an arm like the arm in your hand. What that means is it's a loan for 30 years. The rate is fixed for 30 years, and it's also amortized for 30 years. You're probably thinking like, duh. Isn't all loans like that? Not really. Some loans are a bit differently. For example, as you see right below that, you have a 5-1 arm. It's fixed for 5 years. It adjusts for 25 years. Every annual adjustment, it can annually adjust, but it's still amortized for 30 years. Okay? You might have, an interest-only loan for 12 months or, 5 years, but it's amortized for 30. That means the payments are divided as a 30-year loan, but it's only fixed for a certain period of time. Hopefully you're getting the point here. So a 5-1 arm fixed for 5 years, adjusts once every year for the next 25 years, but it's amortized for 30 years. Okay? Hopefully you're following along here. But let's get back to the top here. So what does this mean? On top we have, for a 30-year fixed, these is the credit score. Based on the credit score, it will dictate the rate, and it will also dictate the LTV. As you can see here, these numbers up top, these are the LTV, loan to value. Let me dummy it down for just a second for anybody that's never used or seen the word LTV. LTV stands for loan to value. So for example, if you have a property that you're looking to purchase for $50,000 and the client wanted 80%, let's just assume they wanted 80%, they only want to bring 20% down, and let's just say they have 760 credit score. What rate would they have? And then how much would they need to bring down? So I'd come right here, they have a 760, and they want to put 20% down, so it would be right here in the 75 to 80% rate, and this gentleman would pay a 7.47 rate today, if he was to close his loan today. Keep in mind, rate changes daily, every second, every minute, it just goes up and down. So the rates are just all over the place. Another thing that with confirming loans, they're usually tied to an index, like the Treasury, or there's a few different indexes in the UK. I can't think of the names right now, but it's usually tied to an index. With non-conforming loans, they just decide what the hell they want to charge based on risk. They don't have to really. It's not tied to any specific index or anything like that. Some of them aren't, but generally a non-conforming loan, you can have something that is just not tied to index, especially when you're talking about like private money loans. You know, like somebody that's rich. If you had $1 billion and you wanted to lend your money out to people, to real estate investors, you can charge whatever you want, whatever the market is willing to take. But for example, that scenario that I just threw at you, borrower looking to purchase a $100,000 property, has a 760 credit score, and wants to put 20% down. In today's world, with this 30-year fix, they would get a 7.47% interest rate. They would have to, of course, come to the table with $20,000 for purchasing a $100,000 property. So now, let's talk about the same individual, the same property, okay? And let's just say they wanted to get a 10-1 arm. Actually, let me even make it even easier. I'm gonna teach you guys even how to go down to calculate what their monthly payment is going to be on that mortgage. So I'm gonna go ahead and pull this up right here, and what we're gonna do is we're gonna do a side by side. So you guys can have an idea of how you can quickly price out a loan, because especially when it comes to real estate, speed is everything, man. You will lose a client fast when you're not moving fast enough. So you got to be very fast with the way you quote stuff. So this specific borrower, first scenario, $100,000 property, okay? And what they're going to do is they have a 760 credit score and they want to put 20% down. We need to figure out what their how much interest rate is going to be. We need to also figure out how much they're going to be putting down as far as down payment, and what their monthly payment is going to be. Okay, payment 20% max, loan to value 80%, monthly payment, interest rate. Okay, and there are certain discounts that we're going to talk about here in just a second, but let's just kind of do this math here real quick. This guy's going to have to bring 20% down. We all know 20% of $100,000 is $20,000. Hopefully we don't have to use a calculator for that, but calculators really make us lazy. We all know that the lender, this loan amount is going to be what? $80,000, of course. Okay? And let's just say that there's going to be an origination fee of 2%. Let's just say we put a 2% origination fee. And then closing costs, which this pertains to underwriting fee, legal fees, or whatever it is. Let's just estimate here it's going to be $5,000. We got this borrower on the phone, and he needs to know today what he's going to pay. So now, it's FICO score, critically important. Okay, so we go right here. We go to the FICO section. What does it tell us? 760. It's going to be 7.47%. Okay, let's take into account any discounts that might be associated with this. What are discounts, Brian? Discounts are things like, okay, let's just go to adjustments, as you can see on here. So one of the adjustments that I see here is if the property value is less than $125,000. I don't know why I chose this option, but if the property value, based on this rate sheet, by the way, this absolutely eliminates them even getting an 80% loan, as you can see on there. So immediately I want to make an adjustment. That changes everything right there. This is a really good example, because sometimes this is how real life happens. I didn't expect this to be like this, but I don't want to start over and give you guys just something really simple. So as you can see, I made an adjustment there. So now we're going to have to go to 75% LTV. And with that said, we're going to have to come over here and do some calculation. 75% means they're going to have to put $25,000 down, and the lender is only going to finance $75,000. Okay, let me go ahead and take a slow down break. I know I talk too fast. I know sometimes you have a hard time keeping up, so let me slow down for just a second. Hopefully you guys are catching up with what's going on here and why I made that adjustment there. So let's get back to it. Now, interest rate is 7.47, but there is an adjustment here that we have to make. What is the adjustment? We have to add an additional 0.15. Why? Because the property value is less than that 125 that this specific lender has an adjustment for the value of the property. Now, what does that mean? That means that 7.47, we got to add 0.15%. So their rate is actually 7.662. As of right now, we're not done yet with the adjustments, okay? So, more adjustments. This is going to be a purchase. If it was a cash out, there would be an adjustment for a cash out. Right there, 75%. If it's a condo, there will be an adjustment for a condo, as you can see that. If the client is interested in, no prepayment penalty, they have to pay in order to get that, okay? If they do not, or don't really care about a prepayment penalty, then of course they can just leave it alone. But if they don't want no prepayment penalty, they have to pay for that. If they 1 year prepay, as you can see, they have to pay for that. 2 year prepay, they have to pay for that. 3-year prepay. And what does that mean, Brian? That means that if they pay off the loan early, if they pay off the loan within the first year, they have to pay an additional 0.35% of the loan balance in order to pay off the loan. It's going to be added onto their balance. And 1 year, 2 year, 3 year, and then of course up to 5 year, as you can see right there. That's basically what the adjustment is. If not, this is what they're going to have to pay. If it's 2 years, the 3%, and so forth and so on. So, moving on. What other adjustments? 30-year fixed interest with portfolio loan, DSCR, boom, boom, boom. Now, coming right here, loans up to $2 million. Let's see if there are adjustments that we need to make over here. None. DSCR requirements. These are some requirements. What does DSCR mean? DSCR stands for debt service coverage ratio. Okay, and of course, the biggest thing that lenders always want to know. I always say that lenders care about two things only, and two things only: how the hell are you going to pay back, and what the hell is going to happen if you don't pay back. Okay, so DSCR is one of the different tools or calculations used to determine how the hell you're going to pay this back. Okay, so excuse me there, phone just can't stop ringing. Now, lending a single asset. They have an origination fee of 1%. This is what they charge. Okay, so I put 2%. We put 1% on there, and I'll put a broker fee as well. Okay, broker fee because again, you got to get paid 2%. Some lenders charge 0% origination fee. Some lenders, don't charge at all. Whatever the case might be. Yield spread premium. This lender pays out a yield spread, meaning they will actually pay the broker a little something for sending this loan to them. That's what's called a yield spread. So that's actually pretty cool. Not a lot of lenders do that. So based on all the adjustments that I just made and saw, I should say, let me see here if there's any other adjustments that I need to think about. I'm not really thinking of anything right now. Let me see. Now, here we go. Let's determine this. Money needed for down payment. And let's also calculate the monthly payment because the client wants to know what their monthly payment is going to be, okay? So how much money is going to be needed for down payment? The money is going to be needed for down payment. We're going to need $25K right there. They're going to need to pay a total of 3% origination, origination or broker fee total. If you add it up together, 3%. And then $5,000 closing costs. So let's go ahead and get this math real quick. We're going to go ahead and, what is our loan amount? Because everything is based on the loan amount. Loan amount here is $75,000. 1% origination fee, we're going to put that right there. Boom, that's $750. Okay, 2% broker fee, we're looking at what? $1,500, right? So now, we're going to add these numbers plus this number. And that's going to determine what the client needs to come up with their closing. Are you with me so far? Okay? If you're with me, go ahead and nod real quick. So $25,000 plus $5,000 plus $1,500 plus $750. Based on this scenario, the client needs how much to come down to the table with? He's got to bring $32,000, $250 to make this loan happen. Okay? Now, what is going to be his monthly payment? His monthly payment was $75,000 as being the loan amount, and we just want to calculate the principal and interest. I found this calculator that I use. It's pretty cool. It's pretty accurate, actually. It's a calculator. You put $75,000 in here. Okay? No, actually not there. We're going to put $75,000 in here. We're going to eliminate this. I just try to make it simple. I'm not going to put purchase price. We're going to amortize it for 30 years. And what interest rate did we say this gentleman has? Grab that interest rate right there, 7.62%. We're going to slap that right in here, 7.62%. It doesn't matter what the zip code is. We're going to remove the property tax and remove the homeowner's insurance because we're not taking that into account. And basically what you can see, once everything is updated, this gentleman for this specific loan will have to pay $531 a month. Okay? So, two things. I thought I was just going to teach you guys one thing, but I ended up teaching you guys two things. And those two things are how to read a rate sheet and then also kind of how to just quickly price out a deal, something that you can do over the phone with a simple calculator, or just a few minutes. If you ever get that inquiry as to, a client wants to know what they qualify for, how much it's going to cost for the loan or their monthly payment, or how much money do they need to come down with their closing. Let's read another rate sheet from a major lender that deals with QM and non-QM loans. Okay, this is a huge lender out there. Go ahead and get, so these are, as you can see, agency, basically QM loans, then you have your non-QM loans at the bottom there. Let's look at the agency loans, and let me get this password that I need in order to access this real quick. Let's go ahead and put my face on there and put this password. And then we're going to try it. We're going to not try it. We're going to try it. Okay, we do. Okay, we're going to go ahead and teach you how to read another rate sheet. So you can see it doesn't matter how different they look. You still can read any rate sheet. You should not be able to confuse. A rate sheet is a rate sheet. Okay, we're going to make another video on how to read a lender's matrix, basically a document that has all the different lender's products. That's another skill that you have to know. Real business home brokers know how to do this. Okay, so the lender, this is their rate sheet. Rate sheets are adjusted every single day, sometimes even every single second. Okay, and you can see they'll tell you right there what state that they lend in. Extensions is how much extensions cost. For example, if you lock your rate, you have to close that loan on a specific date. If you need an extension, if you're not able to do it on that specific date for whatever reason, then you can pay to have that rate extended if that rate expires. Okay, moving on. As you can see, they have right here government loans right here. These are basically, and this is a lender that actually pays use rate. So at 7% rate, they will finance 102%. So you're probably thinking, hey, what do you mean if somebody's only trying to buy a house for $100,000? What do you mean they're going to finance 102%? What you're seeing here, this is a lender that pays use rate, which means if you give the client this rate, you as a broker will be paid by the lender 2.6%. In addition, of course, subtracting what you get paid by the client, you still can charge the client an origination fee, and then you still can get yield spread paid by the lender, as you see. You can see what I'm trying to show you here. But of course, if they want a lower rate, this is what you call a rate buy down. So if the client wanted a 5% rate, they would have to pay. What's the difference there? You grab your calculator, and you're gonna go ahead and grab that 100 minus 94.596. Clients would have to pay 5.4 points in order to get a 5% rate with this specific product, with this FHA product, as you can see there. Okay, and so forth and so on. This is USDA. This is FHA, Federal Housing Administration, generally for owner-occupied residential properties. You can use it for second home. This is FHA 15-year fixed. This is a VA loan. This is a FHA 5-1 ARM. It's fixed for 5 years, adjusts every year. I believe they amortize that for 30 years. This is a VA 3-1 ARM. Don't get confused with a 3-1, whatever it is. That means it's fixed for 3 years. It's adjusted. ARM stands for adjustable rate mortgage. Okay, 30 years HB stands for I-balance. One thing that really annoyed me, but I kind of, I see why, is all the short abbreviations when it comes to the lending products. HB, so you guys just have to know this stuff, Anyway, moving forward. Every lender is going to have different adjustments. As you can see, these are government adjustments that can be made, and some adjustments either increase the rate or some adjustments either add on to the rate. Okay, so as you can see right here, when you're talking about FICO score adjustments, you would pay an additional premium for having less than a 640 FICO score. As you can see, 660, depending on the product, I should say, okay, based on what's going on right here. But if you have a high score, you actually get a discount, as you can see there. So definitely having a high score does count. This is some other products that this specific lender offers, and of course, this a little bit of the program highlights for this specific product, what this is for, as you can see there. But you can see some adjustments. I don't want to get too deep. This lender offers a lot. They do so much. They have so many different loans, but hopefully you got a sense, or at least an idea, as to how you can read a rate sheet. Hopefully you got an idea and a sense of how you can price out a loan. Just having a quick conversation with the borrower. What is the purchase price? What is your credit score? And then you can determine what type of program do they need. Is it an investment property? Is it a fix and flip? Is it a bridge loan? And basically go to the specific lender, look at their products, quickly figure out a rate sheet, or even Google stuff. Okay, some of these rate sheets are available through Google, and actually just quickly determine if the client needs to know, what do you think my estimated monthly payment is going to be. You can determine that. How much money would I need to have for closing? really important, especially you as a broker. You want to set the right expectations with your clients the whole way. One of the things is you don't want them to show up in closing. They don't have enough money. You need to be checking that. You need to let them know so they can start putting that money in reserve. They will have to show proof of down payment before they close. So as a broker, your job is to help your borrowers prepare for the dance. Okay? So hopefully you learned something good today. If not, I don't know. That's up to you. There's going to be a link in the description. If you want to work together, learn how to become a real business loan broker, not a glorified agent. There's a free, not a free course, a mini course that I created, $37, Wealthy Middleman, and that course will get you an understanding of all the different products that are in the marketplace. And if you're really serious, you can jump into our commission cheat code, or if you want to start your own agency, we also have a course that teaches you how to do that. You learn everything that I know, our systems and everything like that. But link is going to be in the description for all of these. As always, I appreciate you for joining me today. Man, I finally got a haircut. I don't look over here homeless. Okay, I appreciate you for joining me today. Peace out. I'll see you in the next one.